Alex. Alex says, Mike, I have a question about management positions, pre-income methods, excuse me, with the radioactive trading. When the stock is going the wrong way, what are the best adjustments for high and low volatile stocks? Thanks, Alex. Alex, there really is no one answer to that question because it's going to depend on the stock, volatile or not. It's going to depend on the movement, okay? And it also depends on your outlook. That's the main thing that's taught in the blueprint for the 12 different income methods is that SIGA model. What are the current conditions? Now that an event has happened up or down, what are your expectations going forward? What are your goals for the position? And that determines your action. That's explained for each of the 12 income methods. So when a stock has declined, I've got a married put position and the stock's fallen. Let's just put in a fake position very quickly. We'll just go to the custom spread tool. I'll use one of my positions, but we'll simulate. It's not too far of a drop, but let's say we bought 100 shares of KFC at the high at around 31.10 or so a few days ago. And at the same time, we would have bought probably in October or January 32.5 strike put. Price would have been a little bit lower. Let's put it down to about 310 at that time. Okay, so here's the structure I'd look for. A good 5% risk on the position. But the stock's now dropped from where it was at 31. It's not a big drop, Alex, but it's dropped now to 29.98. It's essentially moved down a full strike to the next strike to 30 and a little bit lower. It's right there right now. So now that this decline of $2 has happened, about a little bit less than 10%, of course, around 6 or 7%, what are some of the things that we'd look to do? And again, that's going to depend on the SIGA model for the position. What are the current conditions? A few days after I open the position, the stock has fallen 6 or 7%. Now, whether it's been a month or whether it's been a few days, what we have to ask ourselves now, of course, is what are my expectations going forward? What was the reason for this decline? If I think it's going to continue down, I may choose to get out of the position, Alex. I may evaluate income method number 12. If I think the stock's going to be stable here, well, I might be able to try an income method number 6 position. Or, of course, if I think the stock's going to recover, that's when I might use income method number 9. Okay, so 12 is best if you think it's going to continue down or you think your stock's hit a peak and it's going to fall. Income method number 9 is best used if the stock's fallen and you think it's going to recover. If the stock's fallen 5, 6, 7%, and you think it's going to stay where it is and not move too much from now after this little decline happened, now you have to ask yourself, is it worth it staying in the position to try to milk it, or is it better just to exit with a small loss of 1 or 2% if it's only been 5 or 6 days, because you still have all the time value there? Is it better to exit at that time, Alex, and then move on to the next position? Just take the small loss and move on to a position that's showing you better trends and better goals. And that really applies to any investment. If you've got a covered call that falls against you and you're deciding, do I want to roll down if I don't think the stock's going to recover? Do I want to try to average down in that case to try to lower my cost basis and then sell new calls against it? Well, if you don't think it's going to recover, you think there's potential for further declines with the covered call, it might be better to get out and just look for a position that has the criteria that better matches the sentiment for the trade going forward. Okay, so again, once the decline has happened, you're typically going to evaluate what your expectation is next for where the stock's going to go. And this might be a time where you'd want to use that income method number 9 if you think it's going to recover, or maybe even just leave it alone. But in general, it's better to be proactive in that case for that as well. Okay, and if you think it's going to continue down, you could just sell to close the stock, or you could use income method number 12. That's discussed in the blueprint, of course, in the exiting the RPM chapter. 12 is in the income method number 4 section, as well as other places also in that case. Staying with the married puts, Frank says, if you have a bulletproof married put, meaning we've canceled all of the risk through the income methods and we still have time, what do you do if the stock moves? Well, you can pretty much do whatever you want within reason. So what are we talking about bulletproof? Well, another concept of the radioactive trading is when we start off with a position with the risk, we apply the income methods, that eventually lowers the risk till we can have a position that's potentially bulletproof, meaning we have no risk to the downside and still infinite upside going forward. Okay, we'll take PayPal's at 150. Let me jot this down here. Frank, PayPal's at 150 something. And we're holding the 160 put. Okay. So let's say back a few weeks ago, we got into a PayPal married put, but we bought into it when it was at 130. And at the same time, let's say we bought a January 140 put. Let's see, 10 points away with the 160, so about $26, $27. So we bought the 140 for about $27. Okay, let's take a look here. That's too high of a risk. Let's knock it down to 26. Still probably going to be too high, but that's okay. Anyway, let's say at the end of beginning of April, we could purchase PayPal at 130.25. We entered the 140 put. As the stock moved up to 140, what we did is we did an income method and we adjusted the put. Let's say we rolled from the January 140 up to the 150. Okay, so we sold to close this at one price and bought to open this at another. Now I don't know, this is the current numbers, this looks about right. Okay, so I still have a 6.7% risk. I'm going to cheat real quick for you here, Frank. Let's take this down to what's my risk? I'm sorry, 470. Okay, so anyway, I'm sorry, let's just put this down at 16. Okay. So now we've moved the position up. We're pretty much close to a bulletproof status. This was done, say, at the beginning of May. We moved the put up to lower the risk on the position. Now the stock shot up again. It's at 150.86. So what can I do now? This again, Frank, comes down to the SIGA model for the position. The current conditions, I've got a bulletproof position, no risk to the downside. Okay, pretty close in this case, but you get the idea. And the stock has moved up above my put strike. What are my expectations? Okay, so the expectations, do we expect it to continue to move up, Frank? Do you plan on holding this for another 2, 3, or 4 months? Or are you close to a profit level where you're just thinking about exiting right now? Okay, so the expectations there will help you determine that. Now your goals, talked about in the blueprint, we open up a married put, you usually have 2 thoughts to consider. Are you using this for income, or are you using this for long-term hold and more appreciation? Meaning you're looking for more true profit just from the increase of the stock as opposed to income generation against it. Okay? Okay, so you say you're expecting a drop in the short term and growth long term. All right, so here I am with a near bulletproof position again, and you're expecting a short-term drop. If you're expecting a short-term drop of maybe 5, 6, 7%, you might consider income method number 12 in that case. You could do income method number 6 at this point, which would generate a small credit, not cap the upside, but as long as the stock falls, you're still generating some income on the bulletproof trade. Would I consider rolling down the put and taking my position out of bulletproof status if the decline was bigger than I thought and you're still expecting a rebound? Well, that's a question you have to answer for yourself based on what was the severity of the decline. What level of does it take you out of bulletproof status? Okay, so if you had to adjust with income method number 9, you have a 2% bulletproof position, meaning you're guaranteed a 2 or 3% profit, and the stock falls 7%. And if you use income method number 9, you see that the position would now carry a risk of 4%. Is that worth it to you, or is it maybe just leave the position alone if you're expecting a snapback as well? So depending on your range of decline, you might consider income method number 12 prior to the decline, and then you'd be in a perfect position to reset later, depending on when you think it's going to start a recovery as well. What if the drop in the stock prices is 50%? Okay, so this drops back down to 75. We're holding a 150 put, and we're essentially bulletproof on this position right now with a 1 or 2% gain. Maybe just liquidate the position, unless you think the recovery is going to come back more in a shorter time period. Or you could liquidate now, take the 2 or 3% profit, and reopen the position if you think it's going to recover. Normally, if I have a stock that falls more than 30%, I usually just liquidate it for the loss that I have or the guaranteed profit in the position. But yes, so when you're in a bulletproof position, you could do a lot of things. And once the risk has been canceled, you can, use the different income methods that leave the upside open and still generate premium. You can still sell calls against it on the way down, but you don't want to sell the call too low, because if the recovery happens, you can lock yourself into a loss. Deciding to use 12 prior to the decline or deciding to use 9 after the decline, again, comes down to your expectations of what risk tolerance you're comfortable with, if you're comfortable taking the position out of bulletproof status or not, or if you think the recovery is going to be more. But again, if I have a decline of that type and I can exit the position with a profit, which we showed last week, some of the positions I had, there were 1 or 2 that had a 60% decline while I was holding the stock for a 4-month period, and there was still a 2 or 3% gain on the position because of the structure of the different income methods as well. So I'm more than comfortable to do that. And if I look at the stock later and then it matches my positions, excuse me, if I look at the stock later on after it starts to recover and it looks like I expect now maybe not a gain back of that 50% or so, but I expect, I expect an increase of 5 or 10% from where it is now, and now it's dropped 50%, it's moved up 5%, and I expect another 5% move, maybe I'll start an RPM at that point.